Hey guys, Sharon Joy from Virtual Accounting Strategies on today to talk a little bit about how you can learn accounting on your own. 2015, I was on the verge of bankruptcy. After giving 20 years of my life to corporate finance, I was left alone, broke, and unable to get a job. I'd done everything I was supposed to. Went to school, got a job, and climbed the corporate ladder, but it wasn't enough. But I didn't give up. I picked myself up, I battled back. I partnered with a mentor and learned how to get corporate accounting clients. 7 years later, I made $510,000 in 2022 from my bookkeeping / CFO business and the investments I made along the way. Now, I show others how to do the same. So, accounting is an important term that refers to the day-to-day recording, categorizing, and reconciling of transactions. So basically, accounting keeps you from spending and making money without tracking it. It's an ongoing task. So technically, you really should do this every day. But, we all know life happens. So ideally, you should complete your bookkeeping every month so you can keep a thumb or a pulse on your income and expenses and your overall business performance. So let's go ahead and delve right into how you can develop stronger accounting skills. So first of all, let's understand the difference between bookkeeping and accounting. So bookkeeping and accounting are terms that you hear used often, very interchangeably. However, the skills and responsibilities required for each are somewhat different. Bookkeepers generally keep records of sales and record them in the books directly. They do the day-to-day work of making sure every dollar of the business makes sense and gets spent correctly and gets recorded correctly. An accountant, on the other hand, creates and analyzes financial statements. They can also do audits of the books. They can also help out CPAs and so forth. So bookkeepers and accountants may work in tandem, work together to provide a full level of service to a business. In many cases, though, really the distinction between the two is just a formalized degree. It's either a professional, like a BBA in accounting, a master's in accounting, or you can get a state certification, you can get your CPA, or you can get some industry organization certificates. So let's talk a little bit about some support that we use in accounting. So with every accounting software, one of the other software that accountants usually fall back on is Excel spreadsheets. So usually no matter what you're working with, there's always some Excel spreadsheet somewhere that's supporting it. So going into Microsoft Excel and getting the basics and then keep developing your skills, because this also helps you keep track of graphs and different transactions and stuff like that. So it's a lot of times you use it more as a check and balance for the accounting software itself. So even though you may know some of the basics, it doesn't do you any harm to keep learning. You need to go to the intermediate and advanced levels. You need to be able to learn how to do pivot tables and graphs and charts and so forth to really help support the business. Another thing that you can do to assist in your advancement in your accounting is to just read accounting books. You can go to the library, you can go to Barnes and Noble, you can go to bookstores. There are a lot of online books that you can get. So what I would recommend is looking for like entry-level books that are written by authors who have experience in accounting. So it just makes it a little bit more realistic, a little bit more down to earth when you look for those types of books. Next, you can always take an accounting course. You don't always have to have a 4-year degree, so not everything needed to be a great accountant can be learned in a course though. So let's talk about some accounting basics. So let's talk about understanding dual entry bookkeeping. Accountants make 2 or more entries for each transaction recorded by the business. These can be thought of as an increase in one account and a decrease in another account. For example, a payment made for a sale previously made on a credit would result in an increase in the cash account and a decrease in accounts receivable. Basically, that's money owed to the business by customers who have purchased items on credit but not yet paid. These entries would be made for the same amount, so the amount of the sale. So as you can see, you're going to make a debit, you're going to make on the left side, which is the debit, and on the right side, which is the credit. Everything has to be balanced. So let's talk a little bit more about debits and credits. So when you do dual entry recording, as you do in accounting, they're done in forms of debits and credits. These represent whether or not a certain account is increased or decreased by a transaction. Using them is relatively, if you remember, using them is relatively easy if you remember two things. A debit means the record goes to the left side of the T account, and a credit means you should use the right side. This refers to a standard T account journal entry. A lot of times you'll hear accountants talk about let's T account everything because we know that at the end of the day, the left side has to equal the right side. So let's talk about some of the financial statements T accounts. So assets equal liabilities and owner's equity. This is the accounting equation that you need to memorize above all else. It kind of works as a really good guide to debits and credits. In the portion left of the equal sign, debits increase accounts and credits decrease it. For the items on the right side of the equal sign, the opposite is true. So this means that when asset accounts like cash are debited, they're increased. However, when liability accounts like accounts payable are debited, they decrease. So practice by working out how you would enter different common transactions like paying your electric bills or receiving cash from customers. So here's your example. So let's say that you're paying a bill. You would debit the accrued expense, which is the amount that you owe for the bill, and you would credit cash, which means that you're reducing your cash. So just keep practicing different types of transactions like this, and this will kind of help you remember as you go along. So let's talk about setting up and maintaining a general ledger. The general ledger is where the dual entry transactions are recorded. Each individual record, all of the debits and credits, are made in the relevant account within the ledger. So for a cash bill payment, an entry should be made in the cash account and another one in the expense account. This process is greatly simplified when you use an accounting software like QuickBooks, but you can do it by hand. It's kind of like when you're recording things and you're reconciling your bank account. So this is, again, is where an Excel spreadsheet really comes in handy. So let's talk a little bit more about distinguishing between cash and accruals. A cash transaction is the type of trade that occurs when a customer buys a pack of gum from the store and you receive payment on the spot. And then in exchange, you give them the gum. The accrual, on the other hand, takes into account things like credit, invoices, billing, and so forth, rather than direct payment at the time of business, as well as intangible assets like goodwill, but we can talk about those later on. So let's delve a little bit more into the financial statements. Let's know how the financial statements are created. Let's talk some basics. The financial statements reflect the current financial health of the business and its financial performance over the last accounting period. So accounting periods could be the last quarter, the last month, the last year. It varies depending on your point of view. The financial statements are created from the information contained within the general ledger. At the end of the accounting period, each account is totaled up and you create what's called a trial balance. The total debits and credits in all of the accounts should equal. Again, we're talking about everything has to be balanced when you enter something in your accounting software. If they're not, the account must be rechecked and balanced because somewhere along the line, one of the entries either doesn't agree or you're missing an entry. When accounts are adjusted and correct, the accountant can enter summaries of the information contained in the financial statements. As you study financial statements, you should aim to be able to create your own and be able to identify all the different numbers and all the different parts of the financial statements. So let's move on and let's talk about the income statement. An income statement is the most basic principle of accounting. It records the company's profit margins over a specific duration of time, ranging from anywhere from a week or a year or a month or a quarter. It really depends on, again, like I said earlier, the point of view that you're looking at. Revenue is an inflow of cash in exchange for goods and services earned over time, though it's not necessarily the money that's actually paid to the company at the time. Revenue may include cash transactions as well as accruals. If accruals are included in the income statement, then the revenue is given a week or a month or a year and takes into account the invoices and bills that were sent out during that time, even if money will not be collected until the next income statement period. Income statements are therefore intended to show how profitable business was during that period of time, not necessarily how much cash the business took in during that time. There's a slight distinction there. Most businesses you work on, you may have heard accrual accounting versus cash accounting. And we'll talk some more specifics about that later on. But when you're doing cash accounting, you're more concerned about the cash that comes in during the period. When you're doing accrual accounting, you're more concerned about the sales that was made during the period. So let's talk about some expenses. Expenses are any use of money to the company, whether due to the cost of sales, the cost of materials, the cost of labor, the cost of supplies. So much like revenues, expenses are reported during the period of time in which those expenses are incurred, not necessarily when they're paid. So for instance, this month you may use electricity. So you would record the expense for the electricity this month, but you're actually going to pay the bill next month. So you're not concerned about when the cash goes out when you're doing accrual accounting. You're concerned is when the expense actually occurred. This kind of brings us to the matching principle. The matching principle of accounting requires the company to match expenses with revenues together whenever possible in order to ascertain a company's actual profitability over a course of a given time. In a successful business, this should be more or less results in a case and effect relationship where, for example, increased sales will increase the company's revenue while also results in business-related expenses. An increased need to buy more supplies for the store and an increase in expenses for the sales of commissions, increase in wages, and so forth. That's what we call the matching. So as sales go up, you would expect your expenses to go up. So we've talked about the income statement. Now we're going to talk about the balance sheet. The balance sheet, unlike the income statement, deals with a period of time. The balance sheet can be thought of a snapshot of your business at any one particular time. A balance sheet has three important components: the assets, the liabilities, and the stockholders, or also known as owner's equity, at a given point in time. It may be helpful to think about the balance equation in terms of the company's assets being equal to the company's liabilities plus the shareholders' equity. In other words, what you have is always determined by what you owe plus what is currently yours to keep. Let's break it down a little bit further. Assets are what a company owns. It may be helpful to think of assets as all of the resources a company has at its personal disposal, namely the vehicles, the cash, the supplies, the inventory, the equipment that the company owns, any cars that it may own. Assets can also be intangibles, so like plants, equipment, intangibles like patents, trademarks, and goodwill. Liabilities, on the other hand, are amounts that are owed to others at the time the balance sheet was created. Liabilities can include loans that must be paid back, any money that's owed to suppliers given on credit, and any wages owed to employees that have not yet been paid. Equity is the difference between the assets and the liabilities. So the equity account seems to trip up a lot of people. So another way to think of equity is that it's sometimes thought of as the book value of the company or the business. If the company is a large corporation, the equity may belong to stockholders. If the business is owned by one single person, then its equity is called owner's equity. Another way to think of the equity is that it's basically all of the earnings, historical earnings that's kept in the company that's not being paid out to anybody, and it's being rolled forward. All of the net income being rolled forward from year after year after year. It's basically what's left over after everything is paid. So let's talk about another statement that you might run into periodically. This is not used quite as often, but it really is quite useful. It's called a statement of cash flow. Essentially, a statement of cash flow specifies how cash has been generated and used by the business, as well as that business is investing in financing activities over a specified period of time. The statement of cash flows is mostly derived from a business's balance sheet and income statement for that same period. Again, it's just showing the ebb and the flow of the cash. It shows what you paid cash out to. It showed what cash you received. It showed the uses of the cash, uses to purchase inventory, uses to purchase fixed assets, uses to purchase investments. So it's not used a whole lot, but it is definitely very useful if you want to look at where your cash is flowing. Moving on, let's talk about some key concepts when we talk about accounting. There's something called generally accepted accounting principles, also known as GAAP. These are the basic principles that guide the accounting practice and rely on a set of principles and assumptions designed to guarantee transparency and integrity in all business transactions. The economic entity assumption is a requirement that an accountant working for a sole proprietorship, it's a business where there's a single person owns the company, must maintain a separate ledger for business transactions that does not include the business owner's personal expenses or transactions. Basically, this is the economic entity assumption is basically talking about you have to keep a separate set of books if you have a business. You can't be intermingling your personal expenses with the business's expenses. Next, the monetary unit assumption. This is the agreement that economic activity, at least in the United States, will be measured in US currency, and therefore only current activity that can be translated in US dollars will be recorded. That's not something that is used a whole lot in small businesses, but it's just something to know when you're dealing with companies that maybe have businesses or interactions with different international entities. Another key policy or assumption in accounting is the time period assumption. So the time period assumption is the agreement that all business transactions will be represented in a distinct time interval, and those intervals will be recorded accurately. These intervals are typically relatively short, at least, like an annual time frame. The reports are made at weekly intervals in many companies or monthly intervals or quarterly intervals. But the report must also specify when that time interval began and ended. In other words, it's not enough to include the date on the report. An accountant has to clarify in that report whether the report corresponds to a week, a month, a quarter, a year, or 5 years or so forth. It's just required that the time period is noted on your statement. Let's talk about the cost principle. This refers to the amount of money spent at the time of a given transaction without taking inflation into account. Now, something that's really important, the full disclosure principle requires an accountant to disclose relevant financial information to any interested parties, especially investors and lenders. So this information must be disclosed either in the body of the financial statements or in the notes at the end of the statements. This really comes more into play when you're dealing with very large companies that have to report out to, like, the banks, have to report out to their investors, have to report out to the SEC, the Security Exchange Commission. So that's when the full disclosure principle really comes into effect. The going concern principle. So this assumption says that the company will remain in operation for the foreseeable future and requires the accountant to disclose any information regarding the compromised future or certain failure of a company. Again, this going concern really only comes into play when you're doing some external reporting to banks and the SEC, because we're making the assumption that anybody external that is reading the financial statements are relying on you to tell them a story, to paint them a story. So as the accountant signing off on this financial statements that's being reported out to the industry as a whole, you're saying that this company has a going concern. It's not going to shut down tomorrow. It's not going to go bankrupt. So you need to be able to put into that statement, disclose in that statement, letting parties know that this company is going to be continuing on in the future. We've spoken about the matching principle earlier on. So that's just talking about matching expenses and revenues in the same time period at the same time. So in other words, so when you record a sale, you need to record the related expenses related to that sale. There has to be some kind of expense to generate that revenue. The revenue recognition principle is an agreement that revenue will be recorded as having occurred at the time the transaction is completed, not when the money is actually paid to the business. So this is really important. We're talking about revenue versus cash. So revenue is saying if I make a sale today, I need to record that transaction today. If I collect on the revenue next month, I'm not going to record the revenue next month. I'm going to record the cash next month. The revenue has already been recorded in the current period. There's another concept called materiality. So it's a guideline that lets accountants use a degree of judgment in determining whether or not an amount is significant or insignificant to report. This does not mean that the accountant may report inaccurately. Rather, it addresses an accountant's decision to round to the nearest dollar, for example. So if you're doing a reconciliation and you're off by a penny, you can use your judgment and pass on doing further work to find that penny. It allows you to say that a certain dollar amount is really not worth the time and effort to spend any more time to find. Let's talk about conservatism. So this is a principle that advises an accountant may report potential losses for a business. In fact, the accountant has an obligation to report losses as soon as they become known. But you may not report potential gains. You have to report actual gains. So the reason for this is you want to prevent your investors from having an inaccurate picture of a company's financial situation. So if you know of a loss, let's say that you had a fixed asset or you had a house that got damaged in a hurricane. You need to record that loss right away. You need to let your investors and your people that are reading your financial statements, you need to know that there is a loss. You don't know what the magnitude of it yet because the insurance company hasn't come out and looked at it to give you a dollar amount, but you need to record that something happened in the business which will significantly affect it. Now, on the flip side, when we talk about potential gains, we can't talk about if we talk to, let's say we ran into a customer and he gave us this big order verbally. We can't record that sale now. We have to wait until there's actually a transaction or a contract that happens before we can record it. That's called conservatism. You record the loss as soon as you know about it, and you record the gain only after you have a firm contract in hand. So the last thing I want to talk about is following the generally accepted industry practices. So these are expectations that working accountants have of other accountants. So this kind of helps guide the industry. So they include things like reliability, verifiability, objectivity, principles that require accountants to report on numbers that other accountants would agree on. So this is both for the professional dignity of the accountant and to ensure that any future transactions are fair and honest. Other concepts are like consistency, comparability. So consistency requires an accountant to be consistent in how he applies various practices and procedures to the financial statements. So for example, if a business changes its cost flow assumption, the accountant for that business has an obligation to record on that change. But in general, so like if you start out recording using the cash basis, you can't just all of a sudden switch to the accrual basis and then switch back to the cash basis. You have to use some consistent principles from period to period. Otherwise, you have to disclose this information so that anybody reading the financial statements will know that there has been a change that's taken place. Another concept is comparability. So this requires accountants to conform to certain standards, which we've talked about previously, the generally accepted accounting principles, to ensure that one company's financial statements can be compared to another company's financial statements. So if I say that I have revenue in this account, anybody reading it would know that revenue includes certain types of transactions. So that's why it's important that we maintain these generally accepted accounting principles. So, all right, team. So that's our basic accounting principles for today. Glad that you joined me again. This is Sharon Joy with the Virtual Accounting Strategies. Please click on the link below if you think that I can help you further, and we can join a mentorship program together. Talk to you soon.